Hello, my name is Haley Wagner, and this is my case analysis. I have done my case analysis over Uber. Uber's big strategic issue is that they've had rapid scaling, which has come with extreme trade offs for Uber. Uber has been growing over the past about 15 years as a large platform business. In some of their areas, they have synergies, and in others, they're facing very big issues, which is leading to losses and bad operations for Uber. Different areas, different services that they offer are losing money, and others are doing really well. So, what's important for Uber is to identify which areas are doing well and focus on those so that in the long term, they can have much more efficient synergies in their platform. This has led to an unclear future direction for them. They've been having some tumultuous company history since they incorporated, and they're still feeling the systemic effects of that. So they're struggling to choose which services that they offer they should focus on to better enhance their platform business. A quick overview of Uber's history. They've had two different CEO eras. They started with Travis Kalanick, who incorporated in 2010 and was the CEO until 2017. Right off the bat, he encouraged diversification, working in the tech space. They worked on offering a wide variety of services that they built up. But unfortunately, Kalanick faced some pretty extreme ethical issues, which led to a bad reputation for Uber. Things like lawsuits and allegations made investors and other tech companies kind of apprehensive to work with Uber. Kalanick was eventually forced to resign in 2017, and Dara Khosrowshahi took over in 2017. He came in focused on expanding services. He brought in a positive reputation, improved company culture, brought in a very positive mindset, and tried to change the way that people thought about Uber in the tech company space. With COVID, Khosrowshahi encouraged an even further focus on diversification, which led to a wide expansion of the services that they offer in their platform business. Let's talk about their platform strategy. Uber utilizes a textbook platform strategy. Their digital platform allows for all interactors with their company to come together in one space and connect with each other. And Uber takes a cut of every connection that they make. So, for example, you may have a company or you may have a customer who orders a simple car, Uber to come pick them up, drop them somewhere else. So they're on the platform ordering a car. That driver is in the platform using their car to come and pick up. They connect with the customer, and Uber just simply takes a cut of the revenue that goes in between them. They have all kinds of services. They have food delivery options. So you've got a restaurant, a customer, and a driver, and money is passing through all of them, and Uber is just skimming off the top as it goes through that transaction. This requires minimal capital requirement. Uber's not having to buy their own cars. They're not having to run their own restaurants, etc., which is very attractive to investors because it means it's easy for Uber to get in and out of spaces without capital losses. This is also an advantage when it comes to solving the strategic issue that Uber is facing because it means that it won't be so hard for Uber to exit different markets and spaces. Diversification. Uber's platform strategy has encouraged big diversification. Like I said, it's easy for Uber to get into these markets, into these services, and they can offer them all in one big platform. So people form digital like brand loyalty. If you've used Uber for one thing, so when it's time to try, you need another service. You might think, oh, I like Uber, I use them, they were reliable. I'm going to go back to them for whatever this other service I need. One bad problem here is that it can lead to over diversification very easily, and this is what Uber is dealing with. It can lead to clouded direction. Uber might be wasting resources and capabilities on services that are not as synergetic with their platform model as others, so there's always a trade-off involved. And this is where Uber's strategic issue is stemming from, this over diversification issue. Competition. Uber is a big market leader. They manage about 76% of the market space in the United States overall of the services that they operate in. They have a great public market share. They're very well known. Part of where they struggle, however, is in international markets. So Uber, in their expansion mindset, has gone to all these different places, for example, Europe. However, in those places, they face bigger competition than they do here in the United States. So what these smaller companies like those in Europe have done is focus on the market that they operate in. Uber is mainly driving, while roads and driving culture in all these different places and laws and regulations are very different. So if a European company can focus specifically on driving people around London and understands everything, for example, about London's roads, while Uber, a US based company, is trying to operate in all these places and they may not have the market expertise that that small European based company does. And this is an issue that they're facing. And this is definitely leading to that strategic issue. And we'll come back to this. Profitability. Like I said, because of the strategic issue, Uber has been dealing with net losses over time. They're having money spent on waste. Not all services and not all markets are as profitable as others. Some markets are simply just not fitting to the Uber business model, and Uber's really struggling to succeed in those areas. Uber also initially faced valuation issues. For example, their IPO, which is an initial public offering, was lower than their pre-IPO valuation by a considerable amount, which is a very concerning thing to happen to a company. Generally, a company going public is appealing, and their IPO tends to be at or higher than that initial valuation, but Uber faced an opposite problem. The main reason for this was that Kalanick is the one who took them public into the public market, and as we discussed earlier, he had that negative reputation in the tech space. Tech is kind of a small, tight knit group, and so your investor in one tech is going to be your investor in another one. And once they know what kind of reputation you have and the kind of lawsuits and contingencies that you may face, that makes investors hesitant to get involved. Looking forward, so the good news is that Uber's financial data has been improving over time. Their amount of issued stock has remained fairly constant. EPS has jumped about $4 in the past 2 years, which is a big deal. That's a big jump. EPS is earnings per share, so it's a bit of a complicated calculation, but it's essentially net income, net earnings per share of stock. I have pulled Uber's stock trends over the past 5 years, and as you can see, they have been on the incline. Their trend line is looking up, which is good news for Uber, financially at least. My final recommendation for Uber regarding their strategic issue of over diversification and dealing with areas that have waste and are not as much as profitable for Uber is that they should identify the most long-term profitable services that they offer on their platform business model and try to focus on those, invest more into those, and try to slowly over time move out of the markets and services that are not as profitable to them. There are a lot of complexities in platform strategy, especially Uber's, but this can really be played to their advantage. It can allow for integration. Like I said, a customer may enjoy one aspect of Uber, so whenever they open up their restaurant, they're eager to get onto Uber so that other customers can interact with them and buy things from them, and that customer will continue to use Uber for other aspects of their life. And like we talked about, Uber is going to take a bite out of all of this. So the more transactions, the more integration, and the more synergy they can see between the services offered on their platform business, the better for Uber. I recommend the use of data-driven tools to accomplish this final recommendation. Things like Excel, Alteryx, Power BI is going to let Uber look at the large quantities of data that they must be dealing with in a more effective way. But as they do this, I recommend that they decide on quantitative factors to evaluate, identify some KPIs, which are key performance indicators, and then create complex decision matrices based on the data that they are able to analyze. Hopefully, this will give them some quantitative direction to follow on what areas are most profitable and what is going to create the most sustainable competitive advantage in the long term. And by doing this, hopefully it will lead to platform consolidation of the services offered, which will maximize synergy between said services on the platform business model. The sources I used in my presentation were their 2025 10K, which is their annual company report of financial data. I read their financial statements, which is how I got their EPS, and was able to look at their income statements and balance sheets over the past 2 years. I used Yahoo Finance to pull in their historic stock trends, and then I used our textbook for the wide variety, or for most of the case information that I pulled for my case analysis. Thank you.